This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to episode 31 of Value Investing. Of the last 2 episodes, I have covered the first 17 investing rules written by Peter Lynch in his book, Beating the Street. And as I mentioned, Peter Lynch is a legendary value investor who outperformed the market for quite a while. Between 1977 and 1990, Peter Lynch was a mutual fund manager and was able to average 29.2% annual return, consistently more than doubling the S&P 500 market index. So he's a quite legendary value investor, and he has a lot of similarities with Warren Buffett and Charlie Munger. So that actually got me interested in knowing more about Peter Lynch, and I purchased 2 books written by him. And the first book that I'm going over with you is called Beating the Street. And I'm going to put a link in the show note to which you can go and buy from Amazon if you want. The book price is very affordable, so I highly recommend that you read this book. But even if you don't worry about it, because I'm going to cover a lot of stuff in that book through these podcast episodes. On today's show, I'm going to continue to talk about the rest of investing rules by Peter Lynch, and I'm going to provide my opinions on each rule. You might think of these investing rules as very basic, but as I mentioned in the previous episode, I think it's very important as a value investor to repeat what we know so that we don't react foolishly when things turn sour and go really bad. So before we get started, let me just give you a quick disclaimer that this podcast is for entertainment purpose only. It is your responsibility to consult with your investment professional for any investment decisions. So without further ado, why don't we get started? Okay, so let's talk about the first rule for today. There is always something to worry about. Avoid weekend thinking and ignore the latest dire predictions of the newscasters. Sell a stock because the company's fundamentals deteriorate, not because the sky is falling. Think about your investment experience. You have probably several stocks in your portfolio. And if you invest significant portion of your wealth in one particular stock, then you probably pay a lot of attention to that stock and the developments in that company. But because of your enthusiasm in that stock, you'll look at a bunch of negative articles related to that company, and you might feel tempted to sell that company based on the negative articles. Regardless of which company you look at, there will be always negative articles. That's the fact. It doesn't matter. So if you go back in time, let's say 10 years before, and if you look at Google stock, then you probably would be able to find a lot of negative articles with respect to Google. However, if you look at last 10 years performance for Google, as you can see from the stock chart, the Google has performed really well. Same for a lot of outstanding companies right now that you probably are interested in investing your money in. So it's important for you to ignore these negative articles and be very objective in terms of how you assess the company's fundamentals. Instead of focusing on newscasters and negative articles or media, what you can do is look at objectively the developments in the company and whether or not the company can operate business profitably in the future. Benjamin Graham, the mentor of Warren Buffett, previously mentioned that investing is most intelligent when it is business-like. So that's a piece of advice that a lot of value investors share with one another. Peter Lynch is basically saying the same thing. There will be always negative things about the company. So if you're the type of person who are susceptible to negative influence by media, then you're not fit to invest your money in the stock market. It doesn't matter which company you're investing your money in, you'll find negative articles. So the reason why I emphasize over and over again in terms of how important it is to have the right discipline and also how important it is to have the stomach and courage to stay in the market, because it is so easy for you to get influenced by different things when you invest your real money in the market. It is similar to going on a diet. So if you want to lose weight, it's basically simple. You have to eat less and do more exercise. It's as simple as that. But there are so many different strategies out there trying to persuade you to follow, when the formula of losing weight is very simple. Eat less, do more exercise. But because of this other influence, you kind of get swayed into the wrong direction and make the wrong decisions. So I hope that you don't make that mistake when it comes to investing your money in the stock market. Okay, so let's move on to the next rule, which says nobody can predict interest rates, the future direction of the economy, or the stock market. Dismiss all such forecasts and concentrate on what's actually happening to the companies in which you've invested. This is in line with what Warren Buffett and Charlie Munger said in the past. So a lot of value investors such as Warren Buffett, Charlie Munger, Peter Lynch, all of them are saying basically the same thing. It is impossible to predict macroeconomic conditions in the future because there are just so many factors that can come into play. It's just not knowable. And Warren Buffett previously mentioned that you have to focus on what's important, but also what's knowable. If it's important, if it is not knowable, then you're wasting your time. And macroeconomic forecast is one of them. However, in my opinion, there are certain cases, certain extreme cases where you might be able to predict the direction of the stock market. For example, if you look at 2000, when a lot of technology stocks had gone up in value to a ridiculous level, you could have predicted that the stock market level for those dot-com stocks could not be sustainable forever. So in that sense, you probably could have pulled out your money from technology sector. By the same token, if you look at 2008 financial crisis, people were so pessimistic about stock market, almost all of the stocks were undervalued to a ridiculous level. Hindsight is always 22. So if you were in that moment, you probably would have been scared and you probably would not have invested your money in the stock market because you saw a lot of negative articles all over the place. But since the market valuation was so ridiculously low, as a value investor, you could have had the courage to invest your money in the market, and over long period, you could have predicted that stock market is going to go up, cannot stay at that level forever. However, I think that those cases are very few. 99% of times, you're not going to be able to predict the direction of the stock market just by understanding GDP, unemployment rate, and so on and so forth. There are just a lot of macroeconomic factors. There are a lot of events that could easily bring down the market more than 15%. And that has been the case historically in the past. Okay, so let's move on to the next rule, which says if you study 10 companies, you'll find one for which the story is better than expected. If you study 50 companies, you'll find 5. There are always pleasant surprises to be found in the stock market. Companies whose achievements are being overlooked on Wall Street. So this is quite self-explanatory. So you basically have to do a lot of homework and spend a lot of time in order to find good undervalued opportunities. So if you invest your time to do the research on 50 companies, then your likelihood of finding undervalued opportunities will go up. If you do 100, it's going to go up more. But you also need to be very careful in terms of what you understand and what you don't understand. And if you feel that you don't have good understanding of such companies, then just move on. You can pass by a lot of investment opportunities and it's fine as long as you find a few investment opportunities where you can invest money. I think that's more than enough to make tons of money as a retail value investor. But there's no free lunch. You basically have to invest your time and do your own homework in order to find these undervalued opportunities. And as Peter Lynch mentioned here, Wall Street is not going to tell you exactly what undervalued companies are in the market. Because if they already have done so, then that means probably it's already baked into the price. So it's better to find out this opportunity by yourself by reading annual reports and SEC filings, proxy statements, and also look at the company's products around you and see if they are catching up recently. And there are just many different ways you can do your own research, but you have to do it by yourself. And you need to have some conviction in order to stay in the market regardless of a lot of negative sentiment in the market. Okay, so let's move on to the next rule. Next rule is similar to the one that we just discussed, which says if you don't study any companies, you'll have the same success buying stocks as you do in a poker game if you bet without looking at your cards. So Peter Lynch is basically saying the same thing. Just study the company before you make an investment. So that's kind of the common theme across the book, where Peter Lynch is saying that you have to do your own homework. You have to learn about the company. You have to learn about the products that the company is selling. And you need to understand fully the business model of the company, the management team. And that's going to lead to better chance of being successful in the stock market. Okay, moving on to the next rule, which says time is on your side when you own shares of superior companies. You can afford to be patient. Even if you missed Walmart in the first 5 years, it was a great stock to own in the next 5 years. Time is against you when you own options. So this is a core concept that value investors should have. So we have to buy good companies, excellent companies with good business model. And if that's the case, the time is on our side. We don't have to worry too much about the company's quarter-over-quarter business results, because that's what Wall Street is concerned about. But if we truly own outstanding businesses that can produce good returns on tangible equity or equity, then we should be able to be rewarded handsomely in the future if we put our money in the long term. Peter Lynch here mentioned Walmart as an example. He said that in the first 5 years, stock price of Walmart after its IPO has shot up quite significantly. But he's saying that it's not too late to buy this company even after huge stock price appreciation. So he said that it was still good, great stock to own in the next 5 years, because if you look at the history of Walmart stock price, it has gone up since then. Instead of looking at historical stock price data, what you have to look at is the fundamentals of the company. And if the fundamentals are still intact, then you can still buy company when you have historical high in terms of stock price. What's better than that? You can just put your money there and just stay in the course, and the management team, the company will generate tons of returns for you. And that's the style that Charlie Munger and Warren Buffett have had in the past when it comes to investing their money. Peter Lynch here mentioned something funny, which is time is against you when you own options. So each option you buy, you will have expiration date. So after that expiration date, either you exercise that option based on the strike price that you have, or you lose the entire thing. So you have very limited time window in terms of growing your money for any options. I haven't bought any options in the past, so I'm not the expert in this area. But what I can tell you is that this is a completely different game. So if you're a value investor, you're trying to use options for hedging purposes, I think it's fine. But other than hedging purposes, if you just buy options without underlying asset, then that's a really risky tool because option will provide you huge leverage. So you either make tons of money or lose tons of money. It sounds very similar to casino or gambling. I highly recommend you stay away from option market if you don't know what you're doing and if you're doing it for purely gambling purposes. Let's move on to the next one. So next one says, if you have the stomach for stocks, but neither the time nor the inclination to do the homework, invest in equity mutual funds. Here, it's a good idea to diversify. You should own a few different kinds of funds with managers who pursue different styles of investing, growth, value, small companies, large companies, etc. Investing in 6 of the same kind of fund is not diversification. The capital gains tax penalizes investors who do too much switching from one mutual fund to another. If you've invested in one fund or several funds that have done well, don't abandon them capriciously. So here, the bottom line that Peter Lynch is trying to get across is that if you don't do your own homework, just own mutual funds. But when Peter Lynch wrote his book, Beating the Street, at that time, we didn't have ETFs. We didn't have a lot of variations of ETFs. But as of right now, in 2018, we have a lot of ETF products with very, very low expense ratio. So my recommendation is instead of investing your money in mutual funds, which will charge you a lot, just invest your money in diversified ETF funds. So most of people follow S&P 500 index and they buy S&P 500 ETF funds. And you can buy almost free of charge. If you look at Fidelity, that company came out with free ETF funds. And also if you look at Vanguard, there are a lot of ETFs charging ridiculously low price. So I think you're going to make more money if you invest your money in ETF funds. Okay, so let's move on to the next rule, which says, among the major markets in the world, the US market ranks 8th in total return over the past decade. You can take advantage of the faster growing economies by investing some of your assets in an overseas fund with a good record. So I think a lot of US investors are biased towards the US market because they are more familiar with the US market. But if you're from a different country like me, I'm originally from Korea, you'll find a lot more undervalued opportunities nowadays in foreign stock markets. Because US market has gone up in value quite significantly to a level where I can't really find a lot of undervalued opportunities. So instead, I pay now attention to Korean market, which I'm very familiar with. And there are a lot of outstanding companies there selling great products and services. So that's where I can take advantage of the value investing techniques that I have learned from the US market. And I can directly apply that to Korean market. But you also have to be familiar with the market. And even though Peter Lynch is mentioning that you can take advantage of international markets for your portfolio, if you don't understand the companies outside of the United States, it's better to stay in the US. But if you're the type of person who are familiar with foreign companies, then feel free to invest your money in foreign international markets. But you have to keep in mind a couple of things. First, there's foreign exchange rate risk. Foreign exchange rate goes up and down just like individual stocks every single day. If you invest your US dollars in foreign international markets, you might be able to pick winners there outside of the United States. But if the foreign exchange rate goes against you, then you might still be losing money. So that's something you need to consider. And second, you have to also consider the business environment outside of the United States, because a lot of businesses can operate profitably within US, but even if you have, let's say, exactly the same business in different countries, the labor rules or business environments, regulations might be different. So you need to familiarize yourself with foreign international markets and how the businesses are conducted there. And finally, you need to understand whether or not you can trust accounting numbers outside of the US, because US is highly regulated in terms of having the right numbers on the balance sheet, income statement, and cash flow. And SEC, the government agency, regulates the entire thing very tightly, so the companies cannot really cheat on investors. But if you go outside the United States, in some cases, accounting numbers are questionable. So if that's the case, then you want to stay away from those markets. So as you can see, there are certain restrictions related to investing your money in foreign countries. But if you know what you're doing, and if you can put your money outside of the United States, and if you don't have to convert back to US dollars anytime soon, then you don't have to worry about foreign exchange rate risk. And if you believe that the business environment is good in foreign country and accounting numbers are trustworthy, then that's the time when you can invest your money outside of the United States. Okay, so let's move on to the final rule. In the long run, a portfolio of well-chosen stocks and equity mutual funds will always outperform a portfolio of bonds or a money market account. In the long run, a portfolio of poorly chosen stocks won't outperform the money left under the mattress. So on this rule, I just want to point out just one thing, which is if you think about the risk of investing your money, people usually think of bonds or money market funds as a safe place to invest their money. And usually people think of stock market as very risky place to put their money in. I think that's quite true in the short term, let's say within 1 year or 5 years. But if time horizon goes beyond 5 years, then stock market outperforms the bonds for the most cases in the past. So if you put your money in money market or in your savings account, then interest that you're going to earn on the money deposited on your savings account is going to be very small. So your purchasing power is going to diminish over time because of inflation. But if you put your money in the stock portfolio, in the short term, you're going to see a lot of volatility. You may have unrealized loss or gain throughout your holding time period. But if you're a value investor and if you pick the right companies, or if you just put your money in index fund, then over time, beyond 5 years, you're going to outperform the money you put it in your savings account. So that has been historically the case, and that will be the case in the future. So it all depends on your time horizon, investment time horizon. And if you believe that you don't need this money for the next 5 years, stock market probably is the better place to put your money in compared to other marketable securities like bonds and money market funds. Okay, so that's it for today's episode. So we have gone through 8 different rules that Peter Lynch mentioned in his book. Over the last 3 episodes, including today's one, we have gone through in total 25 investing rules written by Peter Lynch. And you can find the list of investing rules either in this podcast show note, or you can buy the book through the link that I put in my show note. So as I mentioned before, what I'm going to do in the next episode is that I'm going to show you some techniques that Peter Lynch used in order to identify undervalued securities in the market. Before I end, I want to remind you that 5-star review always goes a long way on whichever platform you listen to this podcast. Thank you very much and see you next time.